$56 billion. I want you to stop for a second. Unless you're driving, please don't stop driving. And just think about that number. 56 billion US dollars.
It's one of those numbers that's so big it doesn't even feel real. It's just abstract.
Exactly. We're not talking about the GDP of a small country here.
You're not even close.
Or, some massive government bailout. This is one single company.
Right.
And that's what they plan to spend in a single year, 2026, just on capital expenditures, and building the stuff that builds the stuff.
It is the sticker shock to end all sticker shocks. I mean, I've been following this industry for a long time, and that number, it made me do a double take.
It's the kind of number that tells the story, It tells you where the whole world is going.
Yeah.
So today is January 18th, 2026, and we are doing a deep dive into the latest financial report from TSMC, Taiwan's semiconductor manufacturing company. And this is not, I promise you, just a boring spreadsheet review.
No, absolutely not. I mean, looking at TSMC's finances is basically like looking under the hood of, I don't know, the entire global tech economy.
Right.
If you want to know where 5G, AI, and high-performance computing are really going, not the hype, not the marketing, you look at where TSMC is pouring concrete.
And that's our mission for this deep dive. We've got the official transcript from their Q4 2025 presentation, their full-year numbers, and what they're planning for the year ahead. We're going to unpack how a company making this much money is spending it, and why they are betting the house on an AI future.
The source material is dense, for sure. But the story it tells is just. It's fascinating. It's about physics and economics and a massive gamble on what they call structural demand.
Okay, let's get into it. Let's start with the 2025 scorecard, because looking at this, it doesn't really feel like a corporate report. It feels more like a victory lap.
Well, it is absolutely a victory lap.
Yeah.
Just look at the revenue. In the fourth quarter alone, they hit $33.7 billion US.
33.7 billion.
In one quarter.
And that's up 1.9% from the quarter before. Now, less than 2% might sound kind of flat, but at this scale, adding that kind of revenue is huge. But you know what they say? Revenue is vanity. Profit is sanity. And their sanity looks pretty good right now.
It's incredible. The gross margin for Q4 hit 62.3%.
62. Hold on. I have to pause you there. Because for anyone listening, a 62% gross margin. Maybe in software, sure. But in manufacturing, making physical things.
It's unheard of.
I mean, Apple is famous for high margins, and they're usually around, 45%? How is TSMC squeezing 62 cents of profit out of every dollar of silicon?
It's an operational masterpiece, really. It comes down to a perfect storm of three things. First, they said cost improvement efforts. So they're just getting insanely efficient.
Okay.
Second, favorable foreign exchange rates, which, always helps. But the third one is the big one, high capacity utilization.
Well, it just means their factories are full. They're running nonstop.
They're running hot, no idle machines. And an idle machine at this scale just burns money. So they didn't have that problem. Every machine was humming.
But it's not just that they're busy. It's what they're making, right? The mix of chips has changed completely.
Right. And this is the whole advanced technology story. In the chip world, smaller is better. So advanced means 7 nanometer and below. In Q4, their 3-nanometer tech N3, the really cutting-edge stuff, that made up 28% of their wafer revenue.
Wow, nearly a third of their money from the absolute bleeding edge. That's got to be hard to do.
And then 5-nanometer was another 35%. 7-nanometer was 14%. You add it all up.
77%. 77% of their Q4 revenue came from these tiny advanced nodes.
That is the market screaming for performance.
Yeah.
It doesn't want the old stuff. And if you zoom out to the full year 2025, that trend is even clearer.
Okay.
For the whole year, advanced tech was 74% of their revenue, up from 69% the year before. The world is just. It's hungry for faster, more efficient chips, and TSMC is pretty much the only restaurant in town at this scale.
And 2025 as a whole was just a monster year for them.
Massive. Total revenue in U.S. dollars went up 35.9% to $122 billion.
Yeah.
And earnings per share, EPS, that jumped 46.4%.
Almost 50% growth in earnings. For a company this big, that's just wild. They're sprinting like a startup. And it looks like they're sharing the wealth a bit, too.
They are. They paid out 18 NT dollars per share in dividends in 2025, up from 14. And for 2026, they've promised at least 23 NT per share.
So business is absolutely booming. But I want to know who is buying all this stuff. For years, the story was always TSMC is the iPhone company.
Right.
If Apple sneezes, TSMC catches a cold. Is that still true?
That is the single most critical insight from this entire report. If you still think of TSMC as a smartphone company, you are running on outdated software. The crown has been passed.
To high-performance computing? HPC.
HPC. In the fourth quarter, HPC was 55% of revenue. For the entire year of 2025, it was 58%.
58%. And smartphones.
Smartphones were just 32% in Q4. For the full year, only 29%.
That's a complete reversal. I mean, I remember when mobile was over half their business. Now HTC is basically double the size of their smartphone business.
And look at the growth rate. For the full year, HPC grew 48% year over year. Smartphones, 11%.
I mean, 11% is still respectable growth.
It's fine. It's stable. People are still buying phones. But 48%, that's a rocket ship. And we should probably define HPC because it sounds like jargon. When TSMC says HPC, they mean the brains inside massive data centers, AI training clusters, supercomputers.
So this is the AI boom right here on the balance sheet.
Mm.
Every time you ask an AI a question, that computation is probably running on a chip that falls into this 58% bucket.
That's exactly it. They've gone from being a mobile-first company to an AI-first company. They did mention the other sectors. IoT and automotive are both sitting around 5% of revenue.
Okay, so smaller players.
Right. Automotive grew a healthy 34%, so cars are definitely getting smarter. But compared to HPC, it's just a different league.
It really shows you where the money is going in tech. It's not about the gadget in your pocket anymore. It's the cloud. All right, so 2025 was the year of HPC. What about the crystal ball? What are they forecasting for 2026?
The party is definitely not over. For Q1 2026, they're forecasting revenue between $34.6 and $35.8 billion. At the midpoint, that's a 38% increase over last year.
Starting the year with almost 40% growth, that's a very high bar.
And the margins are getting even better. They expect gross margins between 63 and 65%.
65%, that's even higher than the 62 we were just marveling at. How are they getting more profitable?
They are, but, and there's always a but, there's some nuance here for later in the year. They were very open about it. They have this phrase they used, puts and takes.
I love that corporate speak. So what are the puts, the good stuff driving margins up?
The good news is all about manufacturing maturity. Their N3, the 3-nanometer process, is getting better. Yields go up, costs go down. They expect N3 margins to cross the corporate average sometime in 2026.
Okay, so they're just getting better at making the new stuff. Makes sense.
Exactly. And utilization stays high. But then you have the takes, the things dragging them down.
And what are those?
In a word, dilution. And this is really key to understanding the global picture. TSMC is expanding overseas. They're building new factories or fabs in the US, Japan, Europe.
Which they have to do, right? It's a geopolitical thing. No country wants all the most important chips in the world made on one island.
Exactly. But that resilience has a cost. It's way more expensive to build a fab in Arizona than it is in Taiwan, where your whole supply chain is, 5 minutes away. They expect this overseas expansion to dilute their gross margins by 2 to 3%.
That's a real hit. You're trading profit for security.
And they said later in the year, it could even widen to 3 to 4%. Plus, there's another factor.
What's that?
Technology itself. They're getting ready for the 2-nanometer node, N2. And whenever you launch a brand new technology, it kills your margins at first. High costs, low yields. That's another 2 to 3% of dilution in the second half of the year.
So they're fighting against gravity. They have to get more efficient just to stay this profitable because all their innovation and expansion is eating away at the margins.
And on top of all that, the tax man is taking a bigger bite. They expect their tax rate to climb from 16% to about 17 or 18% in 2026.
Which brings us, I think, to the main event. The number that started this whole conversation, the CapEx, the $50+ billion bet.
This is the headline of the year for sure.
The official guidance is between $52 and $56 billion. Can you just put that in context for us? How does that compare to what they've spent before?
It's basically a vertical line on a chart. In 2024, they spent about $30 billion. In 2025, they bumped it to $41 billion. Now, potentially $56 billion. They're almost doubling their spend from just 2 years ago.
That is incredibly aggressive. So where is all that cash going?
It's mostly for the really exotic equipment. About 70 to 80% is for advanced process technologies. That's the machines for 2-nanometer and beyond. We're talking about those EUV lithography machines from ASML that cost hundreds of millions of dollars apiece.
The most complex machines humans have ever built, and the other 20%.
About 10% for what they call specialty tech, and then another 10 to 20% for advanced packaging, testing, and masks. And don't sleep on that advanced packaging part.
Why is that? I mean, packaging just sounds like the box it comes in.
Yeah, it's definitely not a cardboard box. For AI chips, you can't just have one piece of silicon. You have to stitch multiple chips together, memory right next to logic, so they can talk to each other super fast. That process is called CoAs, and TSMC is the world bottleneck for it.
So
So
NVIDIA can't sell more AI chips if TSMC can't package them.
you got it. So that slice of the budget is actually critical for the whole AI boom to continue.
Okay, but the big question is, why 56 billion? I mean, 40 billion was already an insane number. Why the giant leap?
They said very clearly, their philosophy is that a higher level of CapEx is always correlated to high growth opportunities in the coming years.
So they're not just spending it for fun, they're spending it because the orders are already lining up.
Precisely. They use that phrase structural demand. They don't think AI is a bubble that's going to pop. They see this as a multi-year fundamental shift in the world. If they don't spend the $56 billion now, they physically won't be able to make the chips that the AIs of 2027 and 2028 will need.
It's an incredible game of poker. If they build it and the demand isn't there, they're stuck with the most expensive empty buildings in history.
That's the risk. But they're looking at their customers, at Microsoft, at Google, at NVIDIA, and they're saying, we believe you. This demand is real.
And there's a cost to this beyond just the cash, right?
Oh, yeah. Depreciation. When you buy $50 billion worth of machines, you have to account for that cost over time. They said depreciation expenses are going to rise by a high teens percentage in 2026.
Yeah.
It's a heavy weight to carry.
And this gets to a really interesting, almost philosophical point they made about the value of all this. I mean, it's getting so much harder to keep making things smaller.
It's the battle between physics and economics. They said the cost to build capacity for N2, the 2-nanometer node, is substantially higher than it was for N3. And the next one, A14, even higher than that.
Why? Is it just inflation?
It's complexity. To shrink transistors now, you need more manufacturing steps, more energy, more exotic materials. The tools cost more. Moore's Law isn't dead, but it is getting unbelievably expensive to keep it on life support.
So if I'm a customer, like Apple or NVIDIA, I'm getting nervous. I know TSMC's costs are going up. I know they have a monopoly. I'm expecting them to just jack up the prices.
You would think so. But they use this very specific phrase. They said, pricing will remain strategic, not opportunistic.
Strategic, not opportunistic. That feels very deliberate.
It is. Opportunistic would be, hey, we're the only game in town for 2 nanometers, so pay us double or good luck.
Which, let's be real, they probably could do.
They could, for a little while. But that burns bridges. Strategic pricing means, look, we have to charge you more to earn a return on this insane investment. But we need you to stay in business so you can keep buying chips from us for the next decade.
It's a partnership. They raise prices enough to cover the $56 billion and keep their margins, but not so much that they kill the golden goose.
That's it, exactly. And they have a clear financial goal. They said they believe a long-term gross margin of 53% or higher is achievable through the cycle.
Through the cycle, meaning even if there's a recession.
Right. And that they think 56% is achievable if things go well. Plus, they want a return on equity in the high 20s. So they're telling shareholders, yes, we are spending a terrifying amount of money, but we're going to do it in a way that keeps us wildly profitable.
It's this crazy symbiosis. The tech giants need TSMC to build the future, and TSMC needs them to pay for it.
And right now, that symbiosis is a machine that prints $122 billion a year.
Okay, so let's try and wrap this all up. We've got the huge victory lap of 2025, the big shift from phones to HPC and AI, the massive $56 billion bet in 2026, and this rising cost of fighting physics. What's the one core narrative here?
The narrative is that the guard has changed. We've officially moved from the smartphone era to the AI era. The financials prove it. And because of that, TSMC is going all in. They're making a $56 billion bet that the world's demand for computing power is structural, it's long-term, and it's basically insatiable. They're building the engine for whatever comes next.
And for you listening to this, why does this matter?
It matters because we talk about the cloud or AI like it's magic, like it's just this ethereal thing.
Right.
But it's not, it's physical.
It feels invisible, but it's made of something.
So every time you see a headline about a new AI breakthrough or a new drug discovered using computation or a smarter self-driving car, I want you to remember that $56 billion budget. That money is the actual concrete and steel and silicon that makes those headlines possible. Without this spending, the software just dread fact. It has nowhere to run.
It really grounds the whole digital world in physical reality. But here's the thought I want to leave you with. We talked about those rising costs. N2 is more expensive than N3. A14 will be even more expensive than N2. Overseas fabs are dragging down the margins. TSMC is winning its war against physics, for now, but the price of each battle is growing exponentially.
The cost of progress.
Yeah. So my question is, how long is that sustainable? If the cost to design and build the next generation of chips keeps going up so dramatically, at what point does the economics of it all just break? At what point does progress become too expensive for even the biggest companies in the world to afford?
That is the multi-trillion-dollar question, isn't it? And frankly, we might find out the answer sooner than we think.
Thanks for diving in with us today.
Always a pleasure.